Great. Thank you, VDoc. Yeah, I'm Bill Watts from Market Watch, and I have to say, as a market watcher so to speak, it's been fascinating to watch the evolution of the alternative data industry and to discover how investors and others are using real-time and long-term insights it can produce. So we have a great panel here to talk about what's new and how it's being used to generate alpha. So I'll just make some just quick introductions. To my left, we have John Farrell from Vertical Knowledge, Jessica Stoth from Fidelity, 𝐏𝐀𝐍𝐄𝐋 of Spatial Risk Systems, and Justina 𝐏𝐀𝐍𝐄𝐋 from URSA. So we just dive right in. John, maybe you can just start off just telling us what's a little bit about your space and what are you finding new and exciting right now?
So I'm up here for a couple reasons. I've been in this alternative data space for a while. I publish on a weekly basis, the Alt Data Weekly, hopefully must reading for everybody in the room. I recently joined Vertical Knowledge. We collect and organize publicly available data from the web at scale and have been doing this since 2006. Count among our customers, U.S. government, over 50 institutional investment firms, hedge funds, mutual funds, that sort of thing, and a growing list of corporations. So we are a data provider. We just provide the data. We don't tell you which stock to buy or sell. We don't advise you on your business. We would just provide the data to help you make better decisions. And so that is growing in interest. Everybody realizes if you listen to any of the conversations that have been had here this morning on AI and LLMs and all that sort of thing, I think it's obvious the importance of the data going into all these models is essential. Everybody's need to have high quality data for that. And the biggest source of data is the internet. And so we have done a yeoman's work of keeping that organized and continue to do that going forward.
Great, thank you. Jessica, I guess you'd be more of a power user of the data. Do you want to, what's new and exciting in your world?
Sure. So right now, I think we realized on the prep that I'm not currently a data vendor, so Fidelity does not sell our data, but I've spent a lot of my career working for various players in the creating and selling data. So I think in this panel, I'll try to represent a little bit of that idea of like data buyer, evaluator, and how to get value out of it. But I'm excited to realize that I'm on a panel with three folks who I had not met before. So often you end up very fun to see folks that you already know, and I've seen a lot of friendly faces. So I've already been learning about the data sets that these folks provide, and gone back and had questions for folks within my team of how we're utilizing data sets. I think the thing I've seen in my career is the explosion, obviously, of the internet available data, and then the spatial data. Those are both things that I think in my space that I sit now, they're not super easy to figure out how to utilize in terms of an investment holding period. But I think we've seen more from sort of a risk modeling and risk management standpoint. So we'll probably get into that as we talk about it. But I think that there are definitely players with a lot of shorter holding periods who've been able to have an easier time monetizing some of the newer data sets that are available.
Ken?
Justine and I happen to be in the alt data set, but in the geospatial category. So you folks know geospatial data, right? Counting cars in parking lots. Someone mentioned oil tanks, anonymized cell phone telemetry for tail foot patterns, monitoring physical assets 24/7. But there's now an emerging opportunity occurring right now is basically understanding climate risk is going to be a major theme for investment managers on a forward-looking basis. And in the current state, right, a lot of corporate self-disclosures. You have a lot of mistrust now with that data, right? It's a specter of greenwashing has taken place. So really, the financial sector has to get down to a more granular level. To really understand physical risks, you need to understand the physical assets where these companies operate, right? And so facility, location, function, ownership, carbon emissions, right? Does it emit carbon, toxic releases? So all these key factors come into play now. And that basically, if you were to put, say, for example, the S&P 500 on a map, you're going to see a lot of material differences amongst those companies. And those material differences will create opportunities for alpha and to better understand the risks behind your investments.
Justina?
Yeah, like Ken mentioned, Ursa Space is also in the geospatial field, more so in satellite and just overall geospatial data aggregation. So where we're trying to really understand the market a bit better is both in the continuous updating and monitoring of other data sets, as well as data fusion to get insight between data sets. So things between, for instance, weather data and asset management. How do we predict things that might happen based around climate risk? How do we predict things that might happen between the oil storage place and the vessel detection and AIS space? How do we use RF in a way that has only been used in the government space before, but is now crossing into the commercial space? So those are the kinds of questions that we're asking in hopes of getting additional insights.
Great, thanks. And that's interesting. I think that leads to another question just around how how different data sets are synthesized or put together, because it seems like you need a diversification of data sets to really produce a meaningful signal. So how does that come together these days?
Yeah, we talked a little bit, I think, in the prep that, I don't do a lot of quant work myself these days. I think as a CIO, they technically, I think, call me the portfolio police. And so I try to check that folks aren't going off the rails. But in all my days as a quant, it's an ongoing unsolved problem to sort of master securities together. And I think that's one of the interesting proprietary assets a lot of firms and money managers accumulate over time. I actually work with a team that we moved from one asset manager over to Fidelity. And I think one of the most valuable pieces of IP that we brought with this team is their historical point in time data set and security master. And being able to now come sit inside Fidelity and look at the proprietary data we have access to, one of the things that slows us down a little bit is mapping all of this data together. So I think at least for quants, and I think it was a point taken on the prior panel, that there's a really big difference if you're trying to use breadth and factor models and deep historical data to make predictions. In that case, you really do need to be able to stitch these data sets together back through time and across securities in order to be able to extract value from them. So that I view as one of the big challenges or things that slow us down in order to be able to stitch these data sets together. That's something I've thought I would have seen greater advances in my career. And we talk a lot about AI, and yet I still feel like when I'm talking to researchers, the things that they're trying to do are deal with like dividend and split adjustments and corporate identifiers changing. We're still talking about that basically exactly as much as we were when I started my career, 15 plus years ago. So I'm waiting on that.
Right. And John, from a data provider standpoint, how do you approach providing?
Yeah, we've listened to our customers, and historically, what we've done is we've provided data, raw data, and a lot of people just want that. They want that terabyte of data delivered clean, consistent, complete. They want it just delivered in that format. But there's only so many people that can handle that and ingest it and put it into their decision-making process. So we have started creating what we call refined products, where effectively we join, tag, organize in a different fashion to just make it easier to ask your proprietary questions. Again, we're not in the business of telling you what stock to buy or sell, but we do want to be in the business of giving you the data that you can ask your own unique question, because the question of the panel is where are the new sources of alpha. I think it's going to come from asking better questions of all this information that exists out there. And so I know one of the initiatives really in the past year, we have a team of about 15 people working on creating these refined products, again, in response to a lot of customers asking us to do so. And hoping to get we are seeing early great response and hope that continues.
Just in terms of real-time, what are some examples of some real-time insights that are popular right now, or that have been useful in this recent environment?
Just to touch on the theme about data connectivity, data governance, right? Everyone talks AI, right? But there's no magic wand there, right? Your data needs to be highly connected and standardized that's fit for purpose, right? And so if you can connect a lot of data, you're going to be in a very advantageous position to do a lot of different things. So for a good example is that at spatial risk, we basically connect dozens of geospatial level data sources, right? And, we can tell you that, here in the U.S., basically, only 20% of electricity production is from renewables, right? And the average facility that basically generates electricity for renewables is less than 100,000 megawatts a year. Nuclear power, on the other hand, averages 14 million megawatts a year, right? If we're going to get to net zero by 2050, I think it's nuclear power, not renewables, right? So if you look at the facts, if you connect the data well, you learn a lot of insight that's counter to what you're hearing in the market today, right? All this sustainability reporting from these corporates, right, which paints a rosy picture. Well, it's not. If you look at the facts and you connect it well, it's a different picture emerges.
Jesse, do you want to
Sure.
chime in?
So at Ursa Space, our flagship product is our oil storage product, measuring tank heights and floating lids across, globally. So our big indicator is how do we correlate that to oil prices. But to echo my other panelists, we're looking more so, clients are coming to us more so looking at things like carbon sequestration, carbon capture, verification and validation of climate positive processes. Are providers doing what they're saying they're doing? Are people installing more solar panels? Things along that nature. And they're also wanting to see all of this geospatial data condensed into a product, into something that is digestible easily by an analyst that doesn't need geospatial, doesn't need a geospatial background at all. So that's just touching upon some things that are hot right now, but there's really a big wealth of opportunities there.
Yeah, I just want to add to that there's so much data out there that lives at a geospatial level, but once again, they live in their own little data silos. The data right now, geospatial, is really not fit for purpose for consumption by the financial sector, right? Mm-hmm. So a reference data layer is going to emerge to help answer those questions for people. Instead of these bespoke one-off projects, you're going to have, basically you can track an index from a physical asset location and understand at a granular level what's actually taking place. Mm-hmm.
John, what are your thoughts, I guess, in terms of real-time insights that are...
With alternative data, there is, I think historically the easiest use case was, calling the quarter, seeing that change, between the end of the quarter and the day the company reported, and try to catch that opportunity. And I think that opportunity that still exists. Maybe it's harder to find than it was 5 years ago. But I also think there's a long-term use case for this as well. So if you have a 3 to 5 year time horizon in your investment, you have a thesis that you're going to monitor, maybe not on an hourly or a daily basis, but you're going to monitor that thesis over the course of time. And as facts change, you may need to pivot your position a little bit. So there is an opportunity for alternative data, both near term and looking long term. So I don't think I think maybe it has a little bit of a bad reputation. I don't even know if it's bad, but a reputation of just the short-term guys calling the quarters can use it. Nobody else can use it. I think people are starting to understand that there's a far broader use cases than just that.
Right. So it gets away from the idea that there's a data set that's a silver bullet or... Okay. Jessica, what do you, in terms of, I guess, sifting real time from longer term insights, how do you approach that?
Yeah, well, I think that was a great example. So calling the quarter, my first quant job was at Starmine, and what we were trying to do was build, better subsets of analyst predictions to try to have this predicted surprise. And I remember that was my first project out of grad school. So I got there and I was a biophysicist teamed up with a bunch of computational chemists. And I was like, so what do we actually do here, guys? And they're like, yeah, so these are all these numbers in this table. Analysts pick what they think is going to happen. And then we just figure out a better guess. And I remember I do this whole project, update all the data. And I think they still sell StarMine analyst rankings. I think they're valuable, but the thing I found was the biggest value add in this step of trying to get a smarter prediction was to throw out obviously stale and outlier data. And I was like, oh wow, oh my gosh, guys, we should go tell IBES their mean or average or whatever they call it is wrong, and like they should update it, right? And everyone was like, no, that's like half of what we do here. We don't want to tell them. So this calling the quarter has been around forever. I think people are getting smarter about trying to call it earlier and then play it over multiple quarters and trying to stretch that kind of prediction out. So I think it is a little bit about trying to say, where can you look at something we might have thought of as event data or rapid data and try to like spin it into longer term predictions? Because, that's what I see is if I'm going to use real-time data, it's probably going to be risk management, like in a really real-time case. So, okay, should we go to benchmark on GameStop, right? Or something like this. Or Hawaiian Electric, right? Should we go to benchmark on Hawaiian Electric? Like, what are you doing right in that moment? And I think Judith said earlier, and how are you thinking about, like, is this an isolated problem? Is this a contagion problem? We don't sort of flip and try to get on the other side of quick trades like that. We're trying to look at risk management. So I think that's how I might be thinking about that kind of real-time driven data is from a risk management standpoint. And beyond that, we really need to look for predictive signals that have a very long horizon to them, because the types of products that I oversee now, they're just such higher capacity that we can't move so quickly, and we need to find basically high capacity, longer term ideas, and there are a lot of competitors in that space. So thinking about how do you use data that other folk like either differently or data that other folks aren't looking at or don't have access to if it's proprietary.
Just in terms of when you're looking at data, and is it difficult to find that or to make sure that what works, say, in a bull market works in a bear market?
That's one of the benefits of having, we've been doing this since 2006, so we have this history, this backlog of history, which is extremely valuable, so we can go back and back test. It's a valuable exercise to go through. If you go back to 08 or during COVID times, what happened to your data set? And that's a big part of what we do when we talk to the buy side potential customers is this idea that you back test and you want to make sure you understand your data well enough that you know the holes, where it's strong, where it's weak. But that's an essential part of this entire process for sure.
Well, every quant group I've ever worked with, we've had at least one really smart quant who is like, hey, look what I found. If you split up all these regimes, you can figure out, basically when to lever up, down, turn signals off, on, and you can. But turns out to be really tricky to know today what regime you're in. And so everything I've seen is like, yes, that's true. There are obviously market conditions that will shape what kind of signals are efficacious, but it's very difficult to nowcast and know where you really are. And when you really dig into this regime switching idea, very often the returns you'll find in a backtest are generated across a couple of very specific isolated outlier days or events. And if you are not perfect on catching those, you lose the whole apparent benefit of having been able to regime switch or regime time. So have been in, and I'm sure folks will hopefully come up to me over lunch or cocktails and debate me on this, because there are a lot of passionate regime modelers out there, I think. And it does look very attractive, but I've never personally seen it work all that well in practice.
I would just further add, I think the common theme today has been around, everyone's talking the generative AI game, right? But it all comes back to effective data governance. So before I founded Spatial Risk Systems, I ran reference data at FactSet, right, and data governance. And so, we're in the middle of this big data connectivity arms race. Whoever connects and standardizes the most content, exploits that connectivity, is going to win. So I think when you go back, back to your organizations, right, how well are they organizing things at enterprise level? If they're not, you're going to struggle to kind of build great AI models out of your internal and external data sources.
So I want to go back to a point that John made about the bear versus bull and about the kinds of questions that are asked in these different markets. So ultimately, that's what it comes down to for us is, for instance, during COVID, the big question was what's going on with the commodities supply chain? What's happening here? That's where all eyes wanted to be. So that was the most request that we got as far as a geospatial data provider. Like, please, can we understand what's happening, for instance, in the Suez Canal during that blockage? Can we understand like where our products are, since, you know, people are waiting 9 months to get a couch, things like that. So in these unique circumstances, I know COVID was ultra unique, but ultimately market demands affect us in a way that folks are interested in different aspects of what might be happening, and therefore come to us with different questions.
Right. So the supply chain resiliency, right? So when Hurricane Idalia hit Florida earlier this year, right, 23 counties declared a disaster. So we were able to determine all the power plants in those counties and say that 21% of Florida's electricity was coming out of those counties. So as real-time weather and political events hit, if you understand where the physical assets are, you could start to basically bet on that a little bit, and basically how our supply chains could potentially be impacted by real-time events. And that's another thing you could do with physical assets that you really can't do with the current reporting that's in place today.
Right. And since you mentioned COVID, just wanted to follow up on that. You know, it seemed like COVID, because of the supply chain disruptions and just the general disruption we saw, it seemed like it was something that maybe put alternative data a little bit more in the spotlight. I'm just wondering how you all think it did transform the adoption of alternative data and the industry, you know, in the years since.
Yeah, I can hop in. I think before COVID, there might have been more hesitation to use satellite data, to use just overall, more broadly. Like I said, the big move that I'm seeing is the move from satellite data, RF, et cetera, in the government space into the commercial space. I think COVID really accelerated that, just because folks aren't able to get to the sites where they need to, you know, perform their observations, perform their surveys. They can do that from space. And then also the acceleration of more low Earth orbit satellites, just more interest in the space overall. I think that was really key. And I think that's been the big change, and I think that change is here to stay. So I think before COVID, folks were a little bit more hesitant. Now they're embracing it, from my perspective.
Right.
And I would just add that, look, there's so many satellites in orbit now, right? The space station has a methane emission or carbon emission sensor on it. And so you'll see this gas leak from space, right? But the other key piece of the puzzle is, well, who owns that asset? What happens there, right? And if you don't understand that, you're only answering half the problem, right? Mm-hmm. So combining top-down satellite imagery with this baseline physical asset level reference data together will provide a powerful climate risk solution for the financial sector. That's where we're headed.
Mm-hmm. Jessica?
Yeah, I don't know that it's particularly COVID related, but I think a comment that both of you guys made earlier of the waxing and waning, let's call it, focus on ESG from an asset management and let's call it an investor perspective in the U.S., right? I mean, I think that's been something that's going to be a huge deal in that alternative data space, because when you look at I think long-term mega trend, investors do care about ESG. Again, you can come debate me on that. Maybe they'll get sick of it, but I do think Europe tends to be long-term leading indicator for where our society does go. For exceptions, but just feels like this slow train that's stopping and starting, but still heading to the same location. And the main problem is actually being able to connect the data to say, is this company doing a quote unquote good job? Like, we have these two issues, right? What do we want companies doing? We don't have really any way to get together on that. But even if you could pick a viewpoint, then are they doing it? And we're going through wordsmithing when we think about how we want to talk to companies, micromanaging whether we want to say we encourage or expect you to do something in the future, right? Well, how are we going to know whether we said we encouraged or expected a company to take whichever word we pick, a certain ESG action? It's got to be quantified. And so I think that ESG is going to be not necessarily a COVID-driven concern, but I think ESG is going to be a very big use case for alternative data, the types of alternative data we've been talking about. And I think that you're going to see it becoming more and more and more important for investors to be able to actually show that not just I'm well intended and here are impact investments that have the right intention, but that there are outcomes or that it's quantifiable how I'm allocating my investment dollars against environmental, let's call it. I think environmental is the main, leg of that ESG stool where data has this type of data has a big role to play.
I would just add to that, if you think about it, it probably should be CESG and add climate at the beginning.
Yeah.
So, ESG is going to continue to live, but now we're going to start to drill down to a physical asset level, right? And understanding what's happening at that level with satellite telemetry and other fact-based regulatory data sources that live at the physical asset level is where ESG is headed. I think you're starting to see the big vendors pivoting away from corporate down to an asset level to get a better understanding of what's going on.
John, any thoughts on the COVID?
I saw COVID as a huge accelerant for this process, the whole alternative data space. People were thirsting for information. We were all sitting in our homes waiting for the company to say something 90 days later, and so there was a lot of interest in what's the consumer doing right now, how has it changed right now, that sort of thing, and so it certainly put a spotlight on alternative sources of information to inform what the heck's really going on in the world. And I think that showed people the value, and it's been a continue kind of up and to the right since then too.
And in terms of, I guess, just getting right to the idea of showing people what's really going on. I mean, we've seen this year, we've seen the economy defying calls for recession. Most economists thought we'd be there by now. It's been resilient. I mean, has alternative data, how has that helped steer people towards what's really been going on with the economy?
I think at a geospatial level, what her company does, we'll probably show you some macro views over time, right? Maybe less cars in a parking lot. Maybe the manufacturing facility outside Detroit is not running a third shift anymore, right? So there's some really telltale signs that are, from a physical asset monitor perspective, that can come into play here.
I can't say it better myself. Yeah, that's a lot of what we do is how do changes on the asset level, because a lot of what we do is data fusion. It's utilizing who owns what, where is a vessel going from port to port, who owns that vessel, who is docking it. That's all part of what we do. So it's taking the macro trends of what we see in satellite data, in weather data, and then applying it to the asset level, because otherwise it's just, pictures on a map, right?
Mm-hmm.
And I just want to finish. Most of the work done today is very bespoke on a company-by-company basis, right? A reference data level has to emerge for the financial sector to basically take full advantage of this physical asset world that's being created.
Mm-hmm. And just, I guess, on your side, from like web data and that, what's, I guess, sort of real-time economic insights can we?
Yeah, there's a million use cases for all the information being collected off the web. You can watch what companies are doing with regards to pricing, inventory, in response to if their demand's increasing or decreasing. And so that could be done in consumer-facing businesses, but also industrial-facing businesses, healthcare, and you can watch how the companies are reacting to their what they're seeing from an end demand perspective.
Mm-hmm. Okay, great. Just shifting gears a bit, but just wondering, in terms of when it comes to data quality and figuring out what you've got, what are the keys to evaluating the quality when you're dealing with multiple data sets and putting that together?
Sure. So from my perspective, I'm still stuck in quant world. So unfortunately, ideally, I need a sort of normalized data point for every company that I care about ranking, which is like every company. That is this big barrier to monetizing or utilizing data sets that might give me an incredibly specific picture about one company. I don't invest in one company. I rank companies 1 to 3,000, right? Or 1 to 50,000. Might sound super boring, but I do not care anything about one company unless I have enough other companies with the same data set to compare it to. So completeness and breadth, I think, is a really big challenge for quants. I have seen, I think, in an attempt to try to capitalize on all of this alternative data, I think some quants have tried to push the envelope to build smaller and smaller types of models that they stitch together. So there's long been a lot of talk about, can't you make a quant model that doesn't need to use all the same factors across a big breadth of stocks, but can just look at the specific KPIs that are relevant for a given industry or a given subset of companies. And I do think folks are getting some success with those kinds of models. The issue then is you're a little bit kicking the problem down the road of, now I need to take all of these little bespoke industry models and I still have to stitch them together because I'm still stuck allocating a portfolio of, $100 across a bunch of stocks. And, in the world I live in now, I'm benchmark measured, right? And so it actually really matters whether I do or don't invest in that company that's a pretty big weight in a benchmark. So I'm kind of still stuck needing to rank companies. So I think for me, number one, breadth, but then number two, history, because we're also stuck in a world of, trying to have enough historical data to be able to gain confidence that the patterns or the correlations or the interactions that we see are, statistically significant. Like we talked about earlier, quants are stuck exploiting these little small signals. And if you can't apply leverage, which in my products I can't apply leverage right now, then you really, really need to be able to sum up a lot of little small predictions. So breadth and then history. And I assume from vendors I'm going to get high quality data, as good as can be done. I think vendors do their best. Then you just need a system of resiliency and checks to catch what do you do when there's missing, incomplete, or obviously erroneous data. So I think that's, you want help from the vendors, but to me that's actually a part where the quants can create a lot of value in their models. Is you've got to be resilient to knowing that you will have real world messy data and build around that.
Having a reference data background, I would further add scope, connectivity, point in time, and really entity resolution disambiguation is the strategic linchpin. When I was at FactSet, we had a reinsurer as a client, and we did an exercise. We basically were mapping all their clients to the ultimate parent. They had like 20 companies they were insuring that rolled up to the same legal ultimate parent, right? This was crazy, right? It comes back to data connectivity and data governance. If you're focused on that, you're disciplined about it, you can create fit for purpose data that can drive all these LLM models and anything else you want to achieve in your organization.
Mm-hmm.
So I'll echo a lot of the challenges, both in having to have a very dedicated model for each industry that we want to look at. We are only able to solve one question at a time, essentially, and then hope that we can have connections in between these questions. Another challenge in the satellite space is we have location as our uniting factor, but then we have to interpolate between time, we have to interpolate between mode, we have to interpolate between orbitology simply, so maybe able to catch like one corner of a space but then not the other, and then not be able to make that connection. We also have the challenge of just general like data usage restrictions of what we do have access to, what we don't have access to, what we can pass on to a broader space, what is exclusive, things along that nature. So all of that is going to prevent us from dealing with our messy real world data and building out more robust models. So opportunities, right?
Right.
And I love the topic of data quality, because with web data collection, web scraping, it's easy to do. People say it's easy to do, we'll do it internally. It's very hard to do well. And it's extremely hard to do well at scale. So if you can do those things, you really have something special. The ability also because things do break, things happen. Data, this type of data is not going to be perfect. I think importantly, not everybody's expecting it to be perfect all the time, but you have to have a process in place where if something doesn't go right, you have to, your customer can't be the one figuring that out. You have to be the one telling them. And with the people we're dealing with, whether it be our government clients or institutional investors, 90% accuracy doesn't really work. You need to be really tight with the data quality, and that's hard to do. And that's one of the, that's very hard to do, and we're right on top of it.
So what's the mix, I guess, between people or users buying the data sort of off the shelf versus something more bespoke that they have their own data scientists and they're working with it? And
So that's an interesting question from my field because we're only recently getting into the data marketplace space. So we are essentially Ursa Space manages a virtual constellation of geospatial data in and of itself, but we're moving into putting our results and insights into the data marketplace on Gristmill, AWS, etc., which is interesting because before we were answering dedicated questions for clients in very niche markets, and we were answering one question. And then now we're able to start to release, in certain cases, the answers to those questions. So we're seeing opportunities of folks taking that data and then doing their own analysis on it, which wasn't really available before just because we were able to either sell the raw data or with our client answer their question. And now we're going into opportunities for folks to take our data, to run additional analysis on it, to use our data mixed with other geospatial data providers, which could be outstanding, but then also faces a lot of concerns around data quality and making sure that they're, following correct data provenance standards, making sure that they're doing like the proper, I'm a remote sensing scientist, so I'm going to think about all the challenges on the technical side and all the things that people could be doing wrong instead of, more the opportunities of what they could be getting. Yeah. So it's an exciting space in terms of data democracy, but I feel like overall, Ken, correct me if I'm wrong, but I really think that it's still a space where, folks have to answer one question. And they need to understand the field that they're working with. They need to understand the data that they're working with, and then have data scientists, engineers, et cetera, solving that problem for them. So I don't know. What do you think, Ken?
Like I said, there's a lot of these large institutions, probably where some of you folks work, have your own climate teams, right? And they're trying to answer those questions leveraging data from Ursa or other providers. But there's no really good solution that tracks physical risks for, say, the Russell 3000, right? At a facility asset level, and that's where we're headed. We're getting there. We're not quite there yet, but like I said, climate risk is going to become a major theme in investing, due diligence, underwriting. I spoke to at least a couple dozen banks, and none of them have any sort of spatial level check in any of their underwriting processes. It's they're 20 years behind. So I think with the work that she's doing, understanding what's happening at a physical risk, physical asset level, these are emerging themes that are going to basically become major themes in the investment management industry over the next couple of years.
So I will say that makes me think of on the ESG topic. So I have a friend who's a climate scientist, and I prevailed upon him to come when I was at Geode, who's a passive asset manager. They said, hey, we want to learn more about ESG. Can you have your climate scientist friend come and talk to us? And started off with like, why bother to have an electric car? Because I plug it in my house and that electricity. And we went through that whole topic. But the thing that he said as we were leaving, when I said, hey, what is the thing that's most underappreciated, like the most well-known climate thing that you think is like, he doesn't really know what priced in, I don't think means, but I tried to phrase that. And he said sea level rise. Like, we know exactly where the sea level is going to be. After he said it, I realized took a walk on a beach somewhere and they had markers showing kind of where the sea level is going to be in the next. And I don't think that is being underwritten or considered appropriately up the chain, to your point. It's very hard to map that all together. But I feel like underwriters and insurers are going to drive that data set maybe before like we asset managers do.
Insurers have their catastrophe models, but having very granular sea level rise data, we actually work with another company because they're probably one of the leaders in that space. And we connect that to our spatial level knowledge graph. That's how we organize our data. Is an important piece of the puzzle. There's really 18 natural disaster risks, but the other piece of the puzzle is that sea level rise is from temperature rise, and really you have to look at where the carbon emissions are coming from, right? in China, 70% of the power comes from coal power plants, right? The total carbon emission on an annual basis in the United States is 2.6 million metric tons, right? And so for every megawatt hour you generate, it's one metric ton of carbon, right? So we calculated coal in China for energy. It's like 3 times the U.S. total for all industries. So we need to understand where the carbon emitters are and really get a good handle on that, because if we can't stem that tide, that sea level rise is going to come a lot quicker.
But exactly. But even if we do, my understanding is, even if we did everything and the best possible arc of trajectory that you could possibly draw out, which seems unlikely, we know a lot of there's a lot baked in already that is you can't put the genie back in the bottle. And I feel like that's underappreciated personally. I don't know. At least I felt like in the circle of people I know, it feels underappreciated.
So another good example, you guys have read all those great sustainability reports by all those U.S. companies. They're waving the flag. We're doing a great job. So we looked at the EPA greenhouse gas reporting program. So from 2011 to 2022, the latest reporting year, the actual reduction in greenhouse gases for U.S. companies is less than 7%, of which the majority is converting from coal power to natural gas power. Talk about being greenwashed, right? And we'll be publishing more metrics on that in the upcoming weeks.
Mm-hmm. Just wanted to get to one of the themes of the morning, the LLMs and AI. I'm just wondering if maybe you could each just talk a little bit about how you're thinking about AI and how it fits into what you're doing.
We are seeing our customers use our data for those models. I don't get a ton of insight into the actual details of those models, unfortunately. But it is going away from just data points, so the things that would fit into a row and a column very nicely, towards, for example, review data. So if there's free text review data going back 12 years on whatever the topic of interest might be, that sort of information, which to the human eye is just, you can't process it. That's kind of ideal for those types of models. So we are seeing that happen. It's very early. The feedback's been, pretty good. They want to continue to ingest that kind of data, so that's usually a pretty good sign. And I'm assuming it's going to continue.
Yeah, I think those models are great for voluminous amounts of unstructured data. So if that's the kind of alternative data that you get access to, I think it's, it was interesting. I'm going to try to catch the Voya guy who has an AI model in production over 3 years. That's a surprising outlier to me. I tend to see more investors and asset managers getting into the space, but being a little bit where I think Pang was, of POC and piloting, just to get comfort. But I do think the intersection of, hey, basically you're not going to get that much bang for the buck if you throw a humongous model at traditional financial tabular data that is the corner case of actually already kind of regulated, mapped together governance, mapped. That's not really going to be where you get your bang for the buck. So I think there's an intersection there. But then yet again, what's fit for purpose? You need, let's say it's LLMs, a lot of text data. And I think where people are finding interesting corners is, they're so cool, especially ChatGPT, because it's basically like magic, right? You can talk to it, and it's basically like magic due to some tipping point of how much data you've got. And we all know that, well, then that's not that useful for these specific use cases, but where you kind of fall back off that tipping point of, it's not that magical anymore, it's my internal proprietary sandbox of data that's very specific, how much better it has to be to justify the cost of training these models. So I think that's maybe where the rubber is going to meet the road is, what types of unstructured data sets at what volumes, and then what is the use case you're going to apply. If I think of a firm like Fidelity, I'm more excited in the near term. Maybe we're talking about sort of next 12 to 18 months versus next 3 to 5 years. I'm more excited in the near term about what can you do with chat and human interaction, client and customer interaction, which is a big cost center for us. And I think that investment use case is more complex and trickier to solve. So is maybe a little further out, at least from what I've seen.
Yeah, getting back to, once again, AI, generative AI, it really comes down to, connecting data, making it fit for purpose, right? The preferred architecture for LLM models are knowledge graphs, which is actually what we've built at Spatial Risk, right? So we connected all our data under a single set of standards. So every data point in our graph, which is billions, is either directly connected or indirectly connected to every other data point. So we basically can answer a lot of questions today. If you want to basically give me the top 5 weather events at any ExxonMobil physical location in the last 5 years, we could take our structured data and turn that into unstructured text and answer that question.
Yeah, as far as the ML space, that's a space that we're really comfortable in the geospatial community. For example, using convolutional neural nets to do object extraction, other computer vision techniques, and just moving target indicators. That kind of like automatic extraction of features from data is a space that we're pretty set in. Obviously, there's always innovation, but that's really a cornerstone of the industry. As far as LLMs go, I think that there's a lot of opportunity, both in connecting data, as Ken mentioned, so extracting things that are necessary on an asset level, but as well, I think there's opportunity in my industry to do better like data fusion and provide context to the data that we are providing. So as mentioned, we're looking at putting out more dedicated products to answer questions, not really big data sets, but instead just an update, a monitor of a situation. And in that case, using an LLM to better index like web scraping data, for instance. We have this wealth of data. We want to only find what is applicable to our case, applicable to this location, applicable to this moment in time, and then create a story around it. We can create like far more efficient products that way that use a lot less like human in the loop analyst time.
Okay, great. Well, I think we're coming up to the end of our time here, so it's been a fascinating discussion. I want to thank our panels, and thank you for listening.
Thank you.